The Moving Average Convergence Divergence, MACD, is one of the most powerful yet easy to understand tools in technical analysis, and when used correctly, it can dramatically improve your entries, exits, and overall win rate in trading. At its core, the MACD measures the relationship between two exponential moving averages, EMAs, typically the 12-period and 26-period, and plots this relationship as a MACD line. Alongside it is a signal line, which is a 9-period EMA of the MACD itself, used to generate buy or sell signals. The difference between these two lines forms the histogram, which visually represents momentum shifts in the market. The beauty of the MACD lies in its ability to combine both trend following and momentum tracking characteristics, allowing traders to identify not only the direction of the market, but also the strength behind that direction. To use MACD for smarter entries, you should focus on identifying crossovers, divergence, and histogram momentum. A bullish crossover occurs when the MACD line crosses above the signal line, signaling a potential uptrend, while a bearish crossover happens when the MACD line drops below the signal line, suggesting a possible downtrend. These signals become even more reliable when they align with the broader market structure, meaning if the price is above a key support zone or an upward trend line, a bullish crossover may confirm continuation rather than reversal. Smart traders don't just jump in after any crossover. Instead, they wait for price confirmation, ensuring that the momentum reflected by the MACD aligns with what's happening on the chart. The histogram plays a key role in refining entry timing. When the bars start growing larger after a bullish crossover, it indicates strengthening momentum, a sign that the trend may be gaining force, and entering at this stage can capture strong directional movement. Conversely, when histogram bars begin to shrink, it signals momentum fading, warning traders to tighten stop losses or prepare to exit. For exit strategies, the MACD is equally powerful. The moment you notice the histogram shrinking after a prolonged trend or a crossover in the opposite direction, it may be time to lock in profits or scale out. For instance, if you're in a long trade and the MACD histogram begins to contract, even though price is still rising, it's an early sign of momentum weakening. This helps you avoid giving back profits by exiting before a major reversal takes hold. Advanced traders enhance this exit strategy by combining MACD signals with key resistance levels or psychological round numbers, such as 1,200 in currency pairs or major Fibonacci retracement zones, to fine-tune timing. Another powerful concept is divergence, when the MACD and price action move in opposite directions. A bullish divergence occurs when price makes a lower low, but the MACD makes a higher low, signaling that bearish momentum is fading and a reversal might be near. Similarly, a bearish divergence appears when price makes a higher high, but the MACD makes a lower high, suggesting the uptrend is losing strength. Recognizing these divergences gives traders an early edge, allowing them to anticipate reversals before most market participants react. To increase your win rate with MACD, it's smart to use it across multiple timeframes. For example, if the daily MACD shows a bullish crossover, look for entries on the 4-hour or 1-hour chart in the same direction. This alignment across timeframes filters out false signals and ensures you're trading with the dominant trend. You can also combine the MACD with other tools like support, resistance levels, volume indicators, or moving averages for added confirmation. Suppose you see a bullish MACD crossover near a major support level with volume picking up. This convergence of signals increases your probability of success significantly. Likewise, during a downtrend, using the MACD to spot short entries after brief bullish retracements helps traders ride the larger wave rather than fighting against it. Risk management also plays a key role in maximizing results. Even with strong MACD setups, using proper stop losses and position sizing ensures you can survive inevitable losing trades and keep compounding over time. The goal is not to win every trade, but to win big when right and lose small when wrong. Another pro tip for smarter entries and exits is to pay attention to zero-line crossovers. When the MACD line crosses above the zero line, it confirms a shift into bullish momentum. Crossing below it signals bearish momentum. Many traders use the zero line as a filter. only taking long trades when MACD is above zero and short trades when it's below, to stay aligned with overall market direction. In essence, the MACD is not just a lagging indicator, it's a dynamic system that helps traders read momentum, identify key turning points, and act with discipline rather than emotion. By understanding how to read its components and applying it across timeframes, traders can fine-tune both entries and exits for optimal precision. The trick is to combine the MACD's signals with clear context, trend structure, price action, and volume to avoid false signals. When you start viewing the MACD as a roadmap rather than a signal generator, you'll realize it's more about timing within the broader narrative of the market. Whether you're swing trading, day trading, or holding positions for longer durations, mastering MACD analysis equips you with a strategic lens that transforms noise into clarity. Over time, this approach builds consistency, reduces impulsive decisions, and helps you trade with the patience and precision that define professional-level performance.